For traders, momentum indicators can be a pretty effective tool when you use it as part of a complete trading strategy. They're worthwhile for swing traders. You want to learn about these. It's going to help you recognize price trends. It's going to help you recognize strength to the entry and exit locations as well. So let's talk about these. Now, indicators in general are pretty useful depending on how you use them. To track the speed, to track the intensity of price movement. So you get an objective perspective when you identify trends and signaling potential price moves that could be coming. So for swing traders, these indicators help confirm the direction of trend and can help pinpoint the best moments for entering and exit trades. And yeah, they're lagging indicators, but a lot of swing traders still achieve success using them. You got a whole range to choose from. Relative Strength Index, the MACD, Stochastic. There's a whole bunch of them out there. And when you use a combination of indicators, you actually get a better understanding of past price action and the current conditions and see if they fit your strategy. So let's talk about the benefits of using them. They're good for validating trend direction. So if both the RSI and the MACD indicate a bullish trend, well, you might be a little bit more confident in taking a long position or increasing your position size. Momentum decreasing, well, if the stock's price is heading in the opposite direction than the RSI indicator, well, this could suggest that the trend is actually weakening and that it's time to close the position. And that's called divergence. We get objective input, which is really important for trading. When you rely on data-driven indicators rather than your emotions or your gut feel, although if you're an experienced trader, gut feel does play a role in your trading. But for most of us, we can eliminate biases, improve our decision-making process with these indicators. Trend and momentum, when you combine trend analysis with momentum analysis, you can actually pinpoint higher probability trade locations that are going to have the potential to head in your direction at least a little bit. So for example, let's say stock price breaks out of a consolidation pattern. The stochastic oscillator confirms the upward price movements. Well, a trader may be more confident entering a long position. So let's talk about 6 tips to use these successfully. Number 1 is you got to develop a comprehensive trading plan. That's number 1 for a reason. The most important thing you can do as a trader. A well-defined plan is going to outline your entry and your exit points, your profit targets, your stop loss levels, keeps you disciplined, keeps you focused. Without a plan, you will eventually be involved in emotional and impulsive trading decisions called FOMO. That's a big one. They usually result in losses. So for example, let's say you specify a 2% stop loss level, or you're exiting if price breaks a support zone. Well, you can ensure that a losing trade does not significantly impact your market capital. You can master market trends and patterns. So if you want to swing trade, you got to spot trends. You got to be able to spot chart patterns. Some traders will closely monitor economic and political developments to help them spot opportunities. Not for me. I don't do that, but a lot of traders do. Robust money management plays a vital role when you're swing trading or trading in general. Stop losses, risk management techniques to minimize your losses. A popular strategy involves risking only a small percent of your trading capital. For example, 1 or 2% on a trade maximum. You also want to avoid over trading because that can result in excessive risk exposure and significant losses, especially during a run of losing trades. When you adopt a disciplined and conservative approach to money management, especially when you start out, it can help you maintain profitability over time. What are the best ones? Well, like we talked about, all indicators are going to offer you objective insights. They're going to help you identify trades, market action, but it's also important to understand not to rely solely on technical indicators, but you want to use them alongside other means of analysis, such as watching chart patterns. There is no best indicator. Risk-reward ratios. When you incorporate these, it can help ensure long-term profitability. And all it does is measures the amount of risk taken relative to the potential profit. So an ideal risk reward should be about 1 to 2, meaning you stand to gain at least twice as much as you are risking. When you use this technique, you increase the likelihood of profitable trades. You minimize your losses. So let's say you enter a trade and a potential target of $200 and a stop loss level of 100. Well, your risk reward is 1 to 2. So when you consistently try to maintain this ratio or close to it, you can offset losses with larger gains, which is going to help you in the long run. But I want you to keep this in mind. There is absolutely no guarantee you're ever going to reach that reward goal. The only thing we can control is when we get in, get out, right? Price can move in any direction, regardless of your potential profit targets. So those ones that say to look for 1 to 3 risk reward, well, they're looking for them. Doesn't mean they're getting them. Remain disciplined and staying focused. Huge. staying committed. It gives yourself a chance to stay away from impulsive and emotionally driven trading decisions. So for example, a disciplined swing trader may have a rule that requires them to sell a stock if it drops below a specific moving average or if the RSI indicates overbought. When they consistently follow these rules, which you hope they've tested, traders can minimize losses, maintain a clear trading strategy. You gotta stay focused on it. How about some techniques for swing traders? I'll be honest with you, trading is not overly complicated. It's just ensuring you stick to some rules and have a plan. So one of the most effective techniques is recognizing support and resistance levels. And this is where momentum and volume indicators can be valuable. So to spot support and resistance, you just look for areas where the stock price has reversed and areas where a newly formed trend may have developed from. So if a pullback occurs on weak volume into this level of support and it's not part of a bearish trend, you could have a solid setup to the upside, especially if momentum returns. You can identify price momentum moves. And this approach means finding stocks that are experiencing momentum in a particular direction. And after you identify these momentum moves, you can enter trades with those stocks to capitalize on the volatility of price. Then you exit the trade when the momentum begins to die off. Now, these moves are going to typically occur after price has been in a trading range with some low volume for a few days or even several weeks. Trading reversals and continuation patterns. It's another technique. There's a lot of them out there. Reversal patterns, they just suggest that the trend reversal may be happening. Continuation patterns indicate that an existing trend is likely to persist. So some popular reversal and continuation patterns, head and shoulders, double bottom, double tops, momentum indicators, they can be useful in identifying and confirming those trade opportunities when these patterns appear. Moving averages. A lot of traders use trend indicators like a moving average. It doesn't matter what they're doing. Day trading, swing trading, scalping, doesn't matter. The most commonly ones, the 20 and the 50-day moving average, the 200, that shows a medium and longer term trend. When you use averages, you can recognize trends and potential areas of support or resistance. So when price arrives at an average, so it pulls back into the 50, for example, look left and see if you can find some sort of price structure that is acting as support. We can also use them to find high probability setups. And these are setups that are just more likely to result in a profitable trade. You can identify these by looking at price action, support and resistance, overbought and oversold, momentum moves, volume. There's potential patterns all over the chart that you may want to trade. So let's pay attention to the confluence of variables for this particular pullback trade here. Okay, confluence, big word. It's important. We have a rising 50 SMA for trend confirmation, simple moving average. We have a bull flag pattern that ends at a double bottom. The stochastics, it's not overbought and it's hooking to the upside. So I just focused on several variables that line up. When you do that, there is a higher probability that price will travel in your direction. How far it's going to go, no one knows. The higher probability setups are going to appear generally at price structure levels, in chart patterns, and when momentum is stepping into the instrument. But there's pitfalls that people fall into. And depending on the indicator or the combination of indicators, you can fall into what we call analysis paralysis. You're just looking at too much. So yeah, the average trader does need to include some type of price pattern and action reading, but let's not get overboard. Using too many indicators or worse, conflicting indicators, that's just confusion. Gives you false signals. You might see one indicator showing an increase in momentum. The other one shows a decrease. What are you going to do? Not adjusting your strategy to changing market conditions as well can be tough. If you're still looking to trade a trend in a sideways market, it can be pretty painful. So let's wrap it up. When you want to master swing trading and you want to use momentum indicators, you got to understand the indicator. That's all. These tools, they can help you. They can confirm trends. They can help you find good entry and exit points. But successful trading in general just requires a comprehensive plan. It requires effective money management and the ability to stay disciplined. So by leveraging momentum indicators and maintaining a strong focus on a particular strategy, you can improve your odds of success in the market. And since we talked about indicators, there's a lot of overused ones out there. A lot of indicators are used wrong. So I put something together a while back. It's called the Ultimate Guide to Price Pattern Trading. It's totally free. It helps you find ideal entry points. It will help you create some sort of strategy to trade from. Again, it's free. The link is to the left or it's down below in the description. And again, we might be pulling this off soon. And so you might want to grab it now. Thanks for watching. Talk to you soon.